Hello, in this video I want to talk to you about the weighted average cost of capital. The cost of capital for a company or for a project is the cost of, think of it as we've got to pay the investors for their money. So if that's debt, then we have to pay interest. If that's equity, then they have a particular sort of minimum desired return that they're looking for on their money, and we want to build that in. And we would use this cost of capital to discount cash flows from a project to basically be able to evaluate the worth of the project, net present value, sometimes we use that for. And so this is really just a discussion of the concept of the weighted average cost of capital, how you would put that together, why you put it together the way that you do, and some thoughts about what impacts the weighted average cost of capital. So we have two learning objectives for this. The first one is that I would like you to be able to explain why the cost of capital from different sources of capital, of investment money, must be combined into a weighted average to determine the appropriate discount rate for evaluating investments. You need to be able to explain what the weighting is and how you would set up a calculation to calculate this. The key sort of aha in here is this concept of the weighting. It's important that you understand how we are weighting things. So just real quickly, I'll do this. In simplest terms, your cost of capital reflects how much your financing costs are. As we talked about, if that's debt, then you would be calculating how much your interest payments are per period, or what your typical interest payment would be, let's just say. If it's equity, then, as we said before, you would want to figure out what the return that's implied by the amount of money you receive and what you give up in return for that to equity investors is. And so for purposes of valuation, then we have those two sort of sources of capital, and we need to turn those into a percentage of the amount that's either borrowed or invested in terms of capital. And so basically what we're going to do is we're first going to go through and just calculate by example how much that cost is in dollar terms, and then we're going to convert it to a percentage, and then that hopefully is going to shine the light on for you how we go about our weighting. So let's talk about the cost of capital, and we're just going to use an example here. So let's just say that you have a project and you need $100,000 worth of financing. Now let's just say that you decide that 50% of that can come from debt. You've negotiated with your lender, whether that's a bank or an investor or whatever it is, and they've agreed that they'll lend it to you for 10% interest per year. Now, I'm not talking here about what the structure of that lending is, whether it's an interest payment per year and then lump sum payment at the end, or whether it's an amortized loan or any of that sort of stuff. We're not even talking about that right now. Let's just put it in its simplest terms and make the assumption that it is 10% per year in interest on $50,000, and so we can calculate that. And let's just then assume that the other $50,000 that we need, so the total $100,000 that we're financing with, the other $50,000 comes from somebody who is investing it as equity. And so as equity, they don't have this guaranteed amount like interest, but you can, as we've discussed in other topics, you can estimate what their return on equity would be based on the structure of the deal or the price that the amount of money that you receive in return for what you give up. And based on that, we will have calculated that the required return, the investor's return on equity, is 15% per year on average, and that means that our cost of equity is 15% per year. And then lastly, we're going to assume that the interest payments are tax deductible and that your tax rate is 25%. Reason we do that, obviously, as we've talked about before, under U.S. tax code, interest expenses are a tax deductible expense for businesses. And so if you think about it, while when things are tax deductible, then while we may pay out $100, we then, by including that, subtracting that from our income before we pay our taxes, we save $25 in tax. And so our net out of pocket is that this really only cost us $75. And so with interest, we want to reflect this tax benefit as a function of the cost. So if we wanted to calculate the after-tax cost of debt, that would simply be the interest on the debt net of tax savings on the interest. And so the interest on the debt is just $50,000 times the 10%, and then less the tax savings. So $50,000 times 10% is $5,000. So basically we would be paying $5,000 a year in interest expenses on this debt. Now, then we have to figure out what the tax savings are. And to do that, we have to basically say, that there's a 25% tax rate, and that effectively our savings are therefore are the 25% times 5,000, or $1,250. Put differently, what that means is, imagine that you enter this $5,000 expense on your income statement for figuring out your taxes. That reduces the amount of taxable income that you have by $5,000, which means that it reduces your taxes by $1,250. And so on a net basis, you didn't pay out $5,000, you paid out $3,750, simply because you saved $1,250 on tax. So then we can go through so going back and summarizing then, basically our cost of debt winds up being $3,750. Simple calculation, that's after tax. After tax cost of equity, we don't have to deal with tax because, number one, there is no explicit required payment to equity. Number two, even if a payment to equity is made, say as a dividend or a repurchase, that is not booked as an expense. Rather, that is a distribution to equity holders. And under U.S. tax code, those distributions to equity holders are not tax deductible. And so the before tax costs and the after tax costs are the same. So here it becomes just the $50,000 in equity that we raised times the 15% required return to the investor, or expected, we should say, return to the investor. So $7,500. So basically we need to be able to put $7,500 into free cash flows to equity for the equity investor each time, and that would make them happy. So if we just said, so what's the total cost of capital? It's just the cost of debt plus the cost of equity, $3,750 plus $7,500. It's $11,250. So you can see that on a dollar basis, it really is just a question of, let's just calculate out what that cost is each time and do it that way. The challenge is that we want a percentage. We want a percentage amount. And so what we're going to do is take the $11,250 in cost. We're going to divide that by the $100,000 total that we raised through debt and equity combined. And so that suggests a cost of capital that's 11.25%. Okay? So you could do things that way. And in fact, if we generalize the formulas that we used, we can get to this a little bit more directly. And so as we've talked about in other examples, generalizing the formula means that where there are numbers, we're just going to replace those with variables and maybe do a little bit of rearranging, if you will, so that we wind up with a formula that we can just plug our numbers directly into. So let's see. Weighted average cost of capital is equal the percentage cost of financing. So as we demonstrated before, that's just your cost of financing per year divided by the amount financed. And as we worked through our prior example, that's cost of debt plus cost of equity divided by amounts financed. All right. So if we were to then generalize the cost of debt, that becomes the amount of debt, which we'll call D, times the interest rate on the debt, which we'll call R little d, less the tax savings. So the math on that becomes D times R little d, so that's the interest rate, times 1 minus the tax rate. It's 1 minus the tax rate because we are subtracting the savings. And so we're basically saying the 1 becomes, oh, here's the interest amount. The minus the tax rate becomes the minus the tax savings. And so it just when you put that together, it's easier to put it in form of 1 minus the tax rate. All right. And so remember, that's your cost of debt is 1 minus the tax savings or tax rate. So that's what your cost of debt is. The return to equity, which becomes our cost of equity, is again the amount of equity, which we'll just call E, times the returned equity, which we'll call R little e. And so it's just equity times R little e. All right, so that's pretty easy. The amount financed is just the amount of the debt, which is D, same D we used above, plus the amount of the equity, which is E, the same amount that we used above. So it's just D plus E. So if we go back up to the top, we've said that we can get to the WACC by doing the cost of debt plus the cost of equity divided by the amounts financed. We now have a generalized formula for cost of debt, a generalized formula for cost of equity, and a generalized formula for amount financed. So we ought to just be able to plug that in. And that's what we've done here. So here's the cost of debt part, D times R little d times 1 minus the tax rate. Here's the cost of equity part, E times R little e. All right, we're just adding those two together. And then we're taking the whole thing and dividing by the amount financed. So you could just use that formula. Okay. Now that does give you a weighted average cost of capital. It is your cost of capital in percentage terms. The only thing that's missing from that in terms of when we talk about weighted average cost of capital is that it's not entirely clear where the weighted part of this comes from. And that just comes from rearranging the formula. I know we've done this before, and I know that, for example, with some of the present value calculations, when they rearrange the formula, sometimes you lose the intuition of that. And so, that's not good. I think in this case, I hope in this case, that this actually adds a little bit to the intuition. So we're going to rearrange this by just taking this d little e that everything is divided by and dividing each term by that separately. So it becomes d divided by d little e. So we're doing d divided by d plus e. Sorry, d divided by d plus e, not d little e. So d divided by d plus e times rd times 1 minus the tax rate plus e divided by d plus e times RE. So literally all we've done is take this thing, move it over to the left, and just sort of focus it on the D and the E. So it's sort of a simple algebraic transformation. All right. By doing that, what we wind up are these two terms. Now what we can think of is this. So this is debt divided by debt plus equity. So it would be 50,000 divided by 50,000 plus 50,000. So debt would be 50%, right? And so this is just the percent of our total financing that came from debt. So that's the weighting, is how much of the money came from where. All right, so that's 50%. This is 50,000 over 100,000, so that's 50%. So 50% of our money came from debt. The other 50% came from equity. We take the amount that came from debt and we multiply it by basically the after-tax the effective after-tax interest rate, which so that becomes RD times 1 minus tax rate. We take the percentage of equity and we multiply it by the required return on equity, right? So, and then we just add those two together. And because these are percentages, what you're effectively doing is taking these percentage returns, these are weightings. So you're taking these percentage returns and you're just putting a weight on each of those returns that reflects how much of the financing came from that particular source. So I don't know if that's clear as mud or not, but if you went through and did this, again, you would wind up with the exact same values. You should come out with the 11.25%. I'm going to leave it to you to actually plug those numbers in to this formula and see that you can come up with the 11.25%. The second learning objective is that I want you to then actually use this weighted average cost of capital for your project. Make some assumptions, I think you probably already have, about how much of your funding is going to come from debt, how much is going to come from equity, and we will have gone through a process where you'll have a better idea what your cost of debt and cost of equity will be. And so I want you to go through the process of sort of solving for that. Then what I want you to do is assume that you shift your percentage of debt and maybe make it a little bit higher, which means that your percentage coming from equity will be a little bit lower. So let's say that you start out saying, oh, I need, make up a number, $200,000, and I'm going to get 60% of it, so $120,000 from debt, and I'm going to get 40%, the rest of it, $80,000 from equity, and you have your rates and you sort of solve for your WACC. So what I want you to do then is say, well, what would happen if instead of getting 60% in debt, we got 80% in debt? So that would be $160,000. So we'd only need $40,000 in equity, and so that would go down to 20% is coming from equity, and see how that changes your cost of capital, right? And then I want you to be able to talk about what having a lower cost of capital would mean to you in terms of having more left over, in profits. And so you're basically improving the value of the project, because after you've paid off what all of the investors require, you're left with more money. So just again, gonna start with a basic set of assumptions. Let's assume for my project that I need to raise $300,000, and I start out by saying I'm going to get $200,000 of it in debt and $100,000 in equity. Well, right away, $200,000 out of $300,000 is 2/3, so I'm going to get 2/3 of the money from debt and 1/3 from equity. The bank is going to charge me 6% interest on my debt because it's secured by assets. I'm going to go ahead and change this. So they're going to give me 6% because it's secured by assets, and we've talked about that on debt, that when you collateralize that debt, that causes the bank to be more comfortable with the fact that they'll get repaid, and so they may lower your interest rate. And then my equity investors, I'm just again assuming they're going to charge me 15%. I'm going to assume I have a 25% tax rate. And so if I plugged all of those things into our prior formula, that's debt over debt plus equity, so that's 200 over 300, times, I don't know why that's 5%, that's my mistake, sorry. Let's just go ahead and fix this. So that becomes 6% times 1 minus 25%, and then we got the equity over debt plus equity, so that's 1/3 times 15%. So it's 2/3, 6% times 75%. We should be taking off 1.5% here, so I guess we're doing this on the fly, and that's going to make it maybe easier for you to do it yourself. So 6% times 75% is actually 4.5%. So we'll change that to 4.5. Of course, you don't have to do anything on this side. So 4.5, what's 2/3 of 4.5? That becomes 3% plus 5% equals 8%. So there we go. We fixed that. So that's my cost basically by financing 2/3 with debt, 1/3 with equity. Now, what if I decided that I would use more debt? The idea here is this. Debt's generally cheaper than equity. Now, there's a limit to that. If you start taking on too much debt, then your lender may raise your interest rate, and they could potentially raise it to the point that it's more expensive than equity and actually turns things the other way and starts making your cost of capital go up. But in sort of a normal range of debt, that usually doesn't happen, and so you can add more debt, and that will actually drive down your rates. So let's just say that instead of going with 2/3 debt and 1/3 equity, you decided that you're going to raise, again, remember we need 350 or 300,000. Instead of raising 200 of it from debt, you're going to raise 250 from debt. Now that means that you only need 50 more of that, so you're going to raise that from equity. So now we're going to put that into our example, but I'm going to correct all of these numbers for the 6%. Okay, so again, in this case, I've got 5/6. That's the weighting, 250 out of 300, and that's going to be times 4.5, because we did that before, and 1/6 times 15. Okay, so if I figure out what 5/6 is, it's 4.5 times 5 equals, divided by 6 equals, that's 3.75%, plus 1/6 of 15, so we'll do 15 divided by 6, you do that divided by, I guess, not times, is 2.5, just like we said. So we would add those two together, 2.5375 becomes 6.25. Okay, and I'll save that. So if you recall from the last slide, when we had 1/3 debt and 2/3 debt and 1/3 equity, we had a cost of 8%. All right, and so if you just said, 8% of $300,000, that's $24,000. So that's our cost, is basically $24,000. Now, because of this, we've gone down to 6.25% because we have basically taken more of it out in debt, which is cheaper. And it's not just cheaper because of the interest rate, it's also cheaper because it's tax deductible. So we've taken that out, and now we've got a 6.25% times. And so, whereas before we could have, again, I'm just going to go ahead and add these in here. So we could have said, so 6.25% times 300,000 equals 18,750. All right. Whereas if we'd done this one, we could have said 8% times 300,000 equals 24,000. All right. So again, the kind of aha here, if you will, is, look, by virtue of the fact that we decided to in this one we decided to go 1/3 debt, 2/3 debt. Sorry, I don't know. I keep doing that. 2/3 debt and 1/3 equity. We're going to have a cost of capital of 24,000. By shifting to having a higher proportion of debt and a lower proportion of equity, we've dropped our total cost from 24,000 to 18,750. That means that we've got, little over $5,000 more dollars left over after tax than we were going to have before each year, and so we've created value by doing this. And so in a nutshell, having that lower cost of capital improves the value of the project. Now, the other way you can think about that is to think about it just from a present value standpoint. If I'm discounting all of those future cash flows at 6.25% instead of 8%, it's going to make their present value bigger, and so that's going to make the value of your project go up. And so ideally, assuming that your project has positive cash flows, that's going to go up. And so that basically means that by lowering the discount rate, you're delivering a more valuable project. So this is the whole point of this is really to make the point that says that the decisions that you make about how you're going to mix and match debt and equity to finance your project also can have a significant impact on the value. So it's not just that the project itself is profitable. It's also how you finance the project that can also improve the profitability of the project by lowering the financing costs. So anyway, so that's kind of wraps up the concept of weighted average cost of capital, and I hope that's useful to you. Thanks.